When most people think about accounting, they think about numbers, rules, and technical requirements. But at its core, accounting is about trust. Investors, employees, lenders, and the public rely on accountants to provide information that is accurate, unbiased, and complete. That's why accounting is often described as a public interest profession, even though accountants are paid by employers or clients. In this video, we'll talk about what that responsibility really means, not just in theory, but in practice. We'll look at professional standards, ethical principles, and a real-world situation where accountants face pressure to compromise their judgment. The key question to keep in mind is this: what happens when ethical principles conflict with real-world pressures? If accounting truly serves the public interest, then we need to understand what defines that responsibility and how it's enforced. That brings us to the organization that has shaped the accounting profession in the United States for more than a century. The American Institute of Certified Public Accountants is not just historically important, it's a large organization that continues to be very influential. The AICPA represents approximately 700,000 members, including CPAs working in public accounting, industry, government, education, and consulting. While it's US-based, it has global influence, which expanded significantly in 2017 when the AICPA merged with the Chartered Institute of Management Accountants (CIMA) to form AICPA-CIMA, and thereby creating one of the largest accounting associations in the world. The merger was strategic. CIMA brought the management, accounting, and strategy expertise, while the AICPA brought the CPA brand, the ethics framework, and U.S. regulatory influence. From an ethics and public interest standpoint, the scale of AICPA-CIMA creates additional complexity. The AICPA writes and enforces a code of professional conduct, influences CPA exams and licensing requirements, advocates for the profession before regulators and lawmakers, and provides guidance that often shapes practice before laws catch up. You could argue that when a single organization represents hundreds of thousands of professionals worldwide, can it continue protecting the profession's reputation and economic interests in situations where it conflicts with the needs of investors, employees, and the public? Case in point, there have been major audit failures, and lawmakers concluded that public company audits required additional oversight, leading to the creation of the PCAOB and the removal of auditing standard-setting authority from the profession itself. Others also argued that the organization is more concerned about representing the business side of the membership than the interests of accountants and auditors, and whether any professional organization of this size can balance all these responsibilities successfully. The larger and more influential a profession becomes, the harder it is to separate protecting the public from protecting itself. Individual CPAs pay membership dues to the AICPA and CIMA, and in theory, the organization represents those members. In practice, though, much of its advocacy, guidance, and standard-setting activity is shaped by the realities of large CPA firms and corporate clients, where the financial and regulatory stakes are highest. This does not mean that the organization acts improperly, but it does mean that there is an inherent tension. The priorities of large firms may not always align perfectly with the interests of individual CPAs, small practices, or the broader public. From an ethics standpoint, this raises an important question. When professional standards are developed, are they primarily protecting the public, supporting individual professionals, or managing the business risks of large firms? The AICPA Code is split into two sections, principles and rules. The principles in the AICPA Code state that members should accept the obligation to act in a way that will serve the public interest, honor the public trust, and demonstrate commitment to professionalism. The big idea here is that the primary responsibility of CPAs isn't just to their clients or employers, it's to the public. That means accountants need to exercise sensitive professional and moral judgment in every aspect of their work. Principles are the high-level expectation, but they're not legally binding. The principles are intentionally broad. They're meant to guide professional judgment, especially in situations where the rules don't give a clear answer. Some of these principles are things you'd expect, like, for instance, integrity, meaning always being honest and straightforward, or objectivity and independence, which means keeping personal biases out of professional judgments. And due care, meaning striving for the highest quality in your work and continuously improving. One aspect of due care is continuing education, and CPAs are required to take continuing education classes every year, ensuring they stay on top of industry trends and maintain the quality of their services. In California, that's 80 hours of CPE every 2 years. 20 of those hours need to be in technical subjects. Not a small task, but necessary for keeping up with the fast-paced world of accounting. Accountants, even if they're not members of the AICPA, should act with integrity, be independent of clients, make decisions objectively, exercise due care, and maintain professional skepticism. On the other hand, the rules are specific and enforceable, guiding CPAs through situations where ethics come into play. Violations are subject to discipline, and the focus is on compliance. And remember, most ethical failures occur because someone technically complies with the rules while violating one or more principles, often the public interest or integrity. CPAs must exercise sensitive professional and moral judgments in all activities, whether at test services or tax and management consulting services. But I can't repeat it often enough. The responsibility to the public overrides the responsibilities to the clients or those who hire and pay them. The public interest includes those who rely on financial statements for lending, investing, and pension decisions. CPAs must continuously develop themselves and maintain and increase their level of competency and quality of services. It's really interesting how closely the AICPA standards align with Aristotle's virtues, values like honesty, integrity, and impartiality. These virtues line up pretty well with the core ethical standards for CPAs. It's all about doing what's right for the public while maintaining trust and fairness. Ethics becomes especially relevant when doing the right thing is inconvenient, costly, or unpopular. Next, let's look at the IMA, the Institute of Management Accountants. With over 140,000 members globally, the IMA supports accountants in business. The IMA has its own statement of ethical professional practice, which emphasizes honesty, fairness, objectivity, and responsibility. IMA members also need to uphold competency, confidentiality, integrity, and credibility. And yes, failure to meet these standards can lead to disciplinary action. The IMA also gives us a useful framework for resolving ethical conflicts. If a member faces an ethical dilemma and the company doesn't have policies in place, the IMA suggests that you first speak with your immediate supervisor. If that doesn't work, move up to the next level of management. Also, the IMA has an anonymous helpline if you need more guidance. You could consult with a lawyer to understand any legal implications, and if all else fails, consider leaving the organization. Remember, management accountants often influence decisions before numbers ever reach the financial statements, which means ethical failures may never be visible to outsiders. Now let's put your knowledge to the test with a real-life case, the 3D printing dilemma. This case involves a private company that has just completed its first year of business. The company Founded after a successful Kickstarter campaign, is preparing its financial statements for the fiscal year ending September 30th, 2021. The CEO, Kyle, wants to recognize $200,000 in revenue for a sale that hasn't shipped yet. The CFO, Madison, who is also a CPA, disagrees as this violates generally accepted accounting principles. Conflict. Kyle wants to include the revenue in this year's statements, but Madison knows that proper accounting requires the product to be shipped before recognizing the revenue. Let's look at how this situation unfolds. Kyle says, Madison, you have to include the $200,000 from A1 printers and revenue for this year. Madison responds, I can't. GAAP requires at least shipment of the product to A1 as of September 30th. Kyle says, you know, we will ship the product in 10 days. What's the big deal? And there are a few more comments here. Madison says, I understand and don't want to be held responsible for missing our target, so it's better to take the hit to earnings now and record the revenue next year. Kyle, I'll worry about next year. And Madison asks, has the board of directors approved this? Kyle says, don't worry about the board. At this point, the meeting broke up, and Madison was told to make the adjustments and include $200,000 revenue this year. The last thing Kyle said to Madison was that she's expected to be a team player. So, what should Madison do? Let's break this down using the AICPA Code. What should Madison do in terms of objectivity? Madison's decision should be based on professional standards, not on pressure from Kyle. She knows the right thing to do is to follow GAAP. What about Madison's integrity? Madison must maintain her professional judgment, even if it means going against Kyle's wishes. If she gives in now, it might set a dangerous precedent. Next is due care. Madison has a duty to make sure the financial statements are accurate and reflect the true state of the company. She has to think about the long-term impact on the public, investors, and creditors. Looking at it through rights theory, Kyle is promoting the ends justify the means approach, trying to manipulate the financials to meet external expectations. But the public interest, in this case investors and creditors, deserve accurate, truthful financial reporting. Finally, justice theory is about fairness. What's fair here is that Madison upholds the company's ethical responsibility to stakeholders by following the rules, not just doing what's easiest. As a CPA who has worked for many companies, this case could have had a far better outcome. The entire situation was poorly planned and prepared for, and in most organizations, an important order of $200,000 would have been discussed far in advance. Perhaps the customer could have accepted shipment before the financial close. It is the CPA's job to be well informed about customers' revenue, costs, as well as the banking relationship. This should not have been a surprise, and Madison and Kyle should have collaborated on finding solutions without ethical conflicts. But now Madison has to stand her ground and do what's right, even if it's uncomfortable. So what should Madison do? She needs to stick to the ethical standards and refuse to recognize the $200,000 in revenue. If that leads to personal or professional consequences, she may need to consider other options, like finding a new job where ethical standards are respected. I hope you enjoyed this video about accounting and the public interest. Remember, the public interest in maintaining integrity in your professional work should always come first, whether you're an accountant, a manager, or anyone in a decision-making role. Stick to your ethical standards and you'll always be on the right track.